Good morning to all. We have a treat for you. For those of you that were at our live educational luncheon here, I guess it was over a month or so ago, fortunately, we could not have with us Mr. Stephen Hall. Steve spoke at our event for many, many years, but now resides in Florida. And so thankfully, we have this technology that we can utilize to now bring Steve to you live. Steve will be updating us what's changed with regards to taxes and how it affects you as landlords, how to mitigate your taxes. And then towards the tail end of the event, we will take questions from the participants. So again, welcome to those of you that are still filing in. If you want to submit your question, or if you have a question for Mr. Hall, you'll see there down at the bottom of your screen, it says Q&A. Go ahead and click that, submit your question, and then we'll be able to get through a handful of those, again, at the end of our webinar here, depending on how long the presentation goes. Now, for those of you who maybe are not familiar with Mr. Hall, Steve family owns a practice in Glendale, California here. Robert Hall and Associates, been around for many, many years, several decades. And full disclosure, Steve is actually my personal accountant. And I think that says something because I entrust my family's financial well-being to him. And truthfully, Steve has saved my family and I many, many dollars in tax savings because of different entities that he's helped me set up, different retirement vehicles, different ways to structure my apartment purchases. And we'll dive into some of that. But Steve, because of I believe, because of his client base and who his family practice serves, individuals of very high net worth, they have to be on the cutting edge of, okay, well, what avenues are available to investors, landlords, that will help them mitigate as much tax as possible. And it's not your run of the mill, well, because my Uncle Larry does my taxes, but again, a true professional. Steve has been a tax professional now for well over 2 decades, and he's going to be sharing his knowledge with us. Of course, I'm trying to just buy a little time here as we're letting more and more people file in. But Steve, welcome. Thank you for being with us here this morning. We know you're a busy guy, but as soon as I stepped off that stage at our event, they said, hey, tell us when we can have at it with Hall. We got questions when it comes to taxes. So thank you for being with us.
Thanks, Chris. I'm honored to be here. And it's like you said earlier, it's been a pleasure working with you over the years and your clients, and seeing their families grow and their portfolios grow. And especially in this day and age when so much has happened the last couple of years. And Chris, how many years have we been doing this forum together?
So we now have been at this 14 years, I want to say.
14 years, it would be great. It's kind of like, when you look at TV shows like Friends, and where they show all the highlights of all the shows over the years, it would be fun to put together highlights of all of our forecasts of what we would predict would happen over the last 14 years, just to see how wild and all the wild twists and turns that have taken place, from the economy to interest rates to land values to the tax code.
Well, that's one of the things that I share with the landlords, is because, we invite landlords and they think, well, there must be to it. What's the catch? And it's like, look, this is just an opportunity for us to ensure that the local landlords are informed of whatever is the pressing issue of the day. So to your point, over the last 14 years, every year has offered something that is of most concern to landlords. Most recently, of course, we dealt with COVID, and then you're dealing with the remnants of COVID, and now you're dealing with the politics post-COVID and current administration, their take on taxes. But it never ends, right? There's always something that we have to be prepared for.
I agree. In fact, I saw there was a bill coming out where I saw this on the media, where they want to allow like the homeless just to camp anywhere they please, and some of the municipalities. And it's just
Mhm.
interesting, whereas in a decade ago, none of us would have ever imagined in a million years that if they're not a paying tenant, that they could be allowed to set foot on your property.
Yeah. Yeah, I don't want to dive into the politics, you know where I lean, but the last few years have been interesting. Even just recently here with this, what is it, Title 42? It's Title 40 something or other. But basically, hey, open borders and what's that going to mean? But yeah, we bring it back home to apartments. Of course, here, local California, we have statewide rent control. We've had that now for several years. And Steve, I don't know if you're aware, but now more and more individual cities are dreaming up their own versions of rent control, which in most cases is more stringent than the statewide rent control. So now investors are having to jockey that in terms of, okay, well, is my city the next to fall? Maybe my city just fell. Do I contemplate then changing cities only to find myself in a different city that then dreams up its own version of rent control a year from now? So landlords have had to stay nimble. They've had to stay informed more than ever. I think they need a pool of advisors that they can turn to. In this case, your firm. I can't tell you how many people have come to our events. They take you up on your offer that you guys will actually review their most recent tax return to say, hey, is there a hole here that you guys find and what have you? How many people have taken your firm up on that, only to then transition because you guys are doing a better job. And that's the point, is that as investors, it's getting more and more difficult. It's only going to get that much more difficult. You need to work with the right professionals. You don't want to be stepping over dollars to pick up pennies because you're trying to shortchange this thing.
Speaking of professionals, thank you, Chris. Well, I'm going to sidebar this real quick, but on the homeless issue, what's interesting is I've had clients tell me that they had concerns about their insurance policy because some of these homeless folks are burning paper to stay warm. And then the embers are going onto the bushes, and then they're creating a fire. And one of the buildings, unfortunately, one of our clients had a fire, literally, because of the homeless population. And so then naturally you're concerned about insurance policies and fire insurance regulations, things of that nature. Have you encountered that with any of your clients in terms of fire safety and insurance compliance dealing with insurance?
Well, insurance, and I'm sure some of the landlords here can agree, is becoming more and more difficult to put on multifamily properties. The insurance carriers are concerned about the electrical and the plumbing in these places, and so they're calling out your sub panels and what have you. Some of them, because of rent control and because of the politics, are turning away insuring multifamily properties because they see it as a liability. What if the landlords cannot make good on the payments and what have you? And so it's getting more and more difficult. So I haven't heard anything specific to, say, homelessness or on the property or these type of things. But even so, that would just add one more issue to it. But just in general, it's getting harder to insure properties because not only are the properties aging, but at the same time, the insurance carriers are concerned with the politics here locally.
Yeah, that's interesting. Something we would have never predicted a decade ago.
No.
In fact, insurance was always an afterthought, where it was cost maybe $1,000 a year, and it was just part of the cost of doing business. But now it could be getting increasingly more expensive item, for a landlord to insure their property.
I just insured a property, and they hit me with a higher premium because we had the older type sub panels, the Zinsco sub panels, and so I updated all the electrical, I updated all my sub panels, only to find out that they said, well, we know, and they were in this transition of no longer covering apartment buildings. So since now they no longer cover apartment buildings, but I'm grandfathered in, I still get to stick with my high premium. Nobody else would insure it for lower. It's just, it's an increased expense. We used to use 40 cents a foot. Can't use 40 cents a foot anymore. It's well beyond that for sure. So, all right, Steve, well, let's dig in. I know that you have a presentation to share with us. So I'm going to quit yapping, give you the floor. You can share your screen with the folks, and we'll take it from there.
Perfect. Let me do this. exercise. Here we go.
Mr. Minikheim, I see your question. We will get to that. But again, reminder, real quick here, Steve, not to cut you off, but just reminder to all, if you have a question for Steve, you want to click the box down below, the Q&A box, type your question in there, and we will get through as many as we can.
Okay, good. So I'm just pulling up the Q&A box so that way I can look at this while we're talking, because like I was telling Chris earlier, for all the folks that are here, we're going to make this interactive versus just me talking and reading off slides. So don't be shy to use the question and answer box this afternoon. And shall I get started, Chris?
Yes, please.
Okay, good. So good afternoon, everybody. Today we're going to talk about tax secrets for landlords. And again, my name is Stephen Hall with our organization, Robert Hall and Associates. And just to give you a little bit of a background, I'm a University of Southern California alumni. I've been in practicing for over 2 decades, and I prepare tax returns for families as well as business owners and landlords. I specialize in the real estate space, as Chris talked about earlier, and has handled hundreds of landlords. And we, as a firm, we've handled over a couple thousand landlords on an annual basis. I have been a keynote for several industries in terms of apartment associations, real estate associations, things of that nature. A little bit about our team. When Chris mentioned earlier, if you ever want a consultation for us to review your scenario, these are the folks on our team that could definitely assist you. We have over a couple 100 years worth of experience here with these folks, and a lot of these folks have also handled IRS audits all the way from filing the return all the way to a 2-3 year of appeals matter to get it settled for pennies on the dollar on tax controversy related cases. So we take pride in knowing what we're doing, and we can take it all the way from the theory to the IRS challenging that theory to getting the IRS to accept the filings as a no change if there is ever an audit. So a little bit about our organization. We have been in business since 1971. We process over 10,000 tax returns annually. We have, if you Google us, you'll see we have 4.9 stars with over 600 reviews. We've won numerous articles, including Glendale's Best Accounting Firm. And I believe it was about a month or 2 ago, we were quoted by the Wall Street Journal in regards to accounting for influencers. I'm sure we all have Instagram nowadays and social media. We have many influencers as clients, and we were talking about the influencer taxation and how things go viral. And ironically, Wall Street Journal picked that up, and we were the subject matter experts on taxation for the influencers. And just give you a little bit of press coverage there. And we've assisted clients with over $1 billion worth of transactions, from real estate operations, management, landlords for apartments, mobile home parks, storage facilities, industrial buildings, duplexes, fourplexes, home development, ground up development, and wholesaling. So if you're in real estate, we definitely understand the different variances and nuances of the industry. And you're going to see we're much more than consultants. We handle tax preparation. We can incorporate folks with their LLCs. We can assist you with bookkeeping, payroll, estate planning, things of that nature, and accounting. So if you want to bypass this presentation and you just want to jump right to a consultation, you could always text us. We'll talk about this again at the end, to the number 72,000 on your phone, and type within the word Robert Hall. And our organization will be able to review your last 2 years of filings, as well as check for potential red flags that you have with your filings. And you'll also be on our email list for periodic email updates. So the legal stuff here, we now have to have a disclaimer, like you said, Chris, with all the crazy stuff going on. We all have our disclosures. So Robert Hall and Associates, RHA, is a tax consulting firm that offers professional tax preparation to individuals and businesses. While RHA caters to the real estate industry, along with many other industries, we are in the business of providing tax advice, not real estate advice and not investment advice. Our enrolled agents are tax professionals who have demonstrated technical competence in the field of taxation. We're authorized by the Department of the Treasury to represent clients before all administrative levels of the IRS for audits, collections, and appeals. So now that I've talked about all those disclaimers, we can jump into the fun stuff. So the biggest question we get from landlords is incorporating right for me? And it depends. It depends on the size of your property, and it depends on what your goals are. And there are various differences when you incorporate. You can have a trust, you can have an insurance policy, or you can have an LLC. And the questions, the first question we received from Ron today is, hey, if I move out of California, but continue to have real estate or income derived from California, is that income taxed in California as well as the state I move into? And the answer is yes, if you're in a state that collects taxes. So for example, if you move from California to Oregon, you'll be taxed in California for your income that you made in California as a landlord. And then you'll also be taxed in Oregon for the income you made in California. But the good news is the tax you paid in California for the real estate income you made in California will convert to a tax credit to the state of Oregon. So if the tax rates are higher in Oregon than California, you'll pay a small difference between California and Oregon in taxes to the state of Oregon, because whatever tax you pay in California will become a credit to the state of Oregon. The reason why I'm bringing this up is that the LLCs, one of the top questions we get from many folks is, can I have an LLC in Nevada or Wyoming for my California real estate? And the answer is yes, you can, but then you have to register that LLC in the state that the property's in. So you could have a Wyoming LLC for that property, but then you still need to register that LLC with the franchise tax board in California to domicile that activity for that specific one property. That's an LLC. In the LLC.
Steve, can I ask you here? Because I've seen investors set up these LLCs, Delaware and all these different places. What's the advantage as opposed to just having your LLC in California? Is there any?
So Delaware is an interesting question. Delaware is a great state for shareholders and stockholders and investors. So if you're raising money, some securities attorneys will recommend to have a Delaware setup LLC, so you can take in those funds if you're syndicating, and then they'll register that LLC in the state that they're operating the LLC in for management purposes. So, and what's happening nowadays is you have a lot of folks that still have assets in California, but they're nomadic, where they live in Airbnbs. Every couple of months they move from state to state, and they don't necessarily stay in one location. So what's a popular vehicle is some folks have assets in multiple states. They'll set up a Wyoming LLC, and then they'll register that LLC in multiple states where all their rental properties are located. That way they only have to have one LLC to represent their portfolio. And the reason why that's important is because if you're not in California and you have assets in California and you have assets in other states, you don't want to be taxed on worldwide income in California. But if you have an LLC in California for all your assets all over the world, and you're not a California resident, you're going to be taxed on worldwide income because that LLC was birthed in California.
Okay.
So that there's so there's different scenarios depending upon where you're physically living. Now, if you're physically living in California and you have assets all over the world, you're going to be taxed on worldwide income in California. But what people forget is if you move, for example, I'm seeing a lot of clients move where their grandkids live, or they move to where their son-in-law and daughter-in-law or their other family members live, and then they're not in California. So now their scenario has changed where they have a California LLC with all their assets. They move to another state, and now they're taxed on all their assets in California because they have a California LLC for all their assets that are in California and out of California, because that LLC was birthed in California. So you almost have to future-proof your plans, especially if your kids are going to college and you don't know where they're going to end up when they get married and settle down and have a family, which is naturally the top reason why folks migrate out of California pre-COVID. They would move closer to their children, as an example. One of the questions here, an anonymous attendee just wrote, Chris, is recently California passed a law that property will get an updated property tax. If there any way to legally to bypass this and keep original property tax for the heirs? What about having the properties under an LLC? Does it help in this case? That's a great question. It's early days as far as what's happening. Chris, what have you seen on this with the update of Prop 13 with property tax and landlords that inherit the property? How is that? How have you seen the counties processing the property tax bills?
To be honest, we haven't had much experience other than getting the question of people anxious because of the recent changes. But I don't have any feedback in terms of how that's played out, what the reality of it is.
Okay, good, great. So for this anonymous attendee, I don't have a good answer about what the legal way to bypass the property tax, because we specialize in federal tax and franchise tax or California tax. We do not specialize in property tax mitigation. And yes, Robert, we're talking about the Prop 19. I misspoke. I said Prop 13 earlier, but you're right, Robert. It's Prop 19 tax reassessment. Now, there's a great tax attorney that focuses specifically on municipal property tax law. His name's Richard Ayub, and I could post the phone number if you guys have these questions for Richard. And he specializes in appeals on property tax reassessments, and he'll attend those hearings for you to reduce the assessments if you have any property tax related reassessment issues that come up. And he's had quite a good track record helping our clients that have dealt with reassessments, and he'll be a better subject matter expert to answer that specific question in regards to property tax assessments. Now, that's a good question to talk about. The next topic here is trusts. What are trusts? Trusts are it's a legal word that means it's a document that's an instruction manual. That's all a trust is. And from a taxation perspective, trust can have many flavors. It could be irrevocable, it could be revocable, or it could be a hybrid. So typically, most trusts are formed like Stephen Spurrier talks about this often. Chris, did Stephen at the last event, did he talk about the importance of them?
Yeah, he essentially went over the point of each property should be in an LLC and the LLC's in the trust, and that's how you run things.
Absolutely. And nowadays, we're also seeing the importance of what's called a special needs trust. And Stephen can help folks that need that. So, for example, let's say you have 3 children, and 2 of the 3 children are very responsible. And the third one, you're worried about how they'll manage their money. We're seeing special needs trusts more often than not get set up. So that way you could have an instruction manual specifying what that heir can do with the money. So that way that heir can't just take the money and give it to their spouse, that if they're in a bad marriage or dealing with or they have other problems, whether it's a disability, things of that nature. So special needs trust is it's really simple. It's just an instruction manual that'll spell out what happens to the funds if you're incapacitated or you cannot manage that the estate plan for the family. So as you can see, trust could be revocable where you could change it anytime, or they could be irrevocable where you could be very specific with your instructions at a specific point in time. And also they could be used as an asset protection tool for protecting your assets. But like Stephen Spurrier said, he recommends the trust to own an LLC, to be the owner of an LLC, and then the LLC owns the real estate. And then the third box here we're talking about here is insurance policies. I always recommend everybody to make sure they talk to their insurance representative to make sure they're properly insured on their properties. And Chris, I mean, these days, how often do you hear from landlords that they're not insured properly, or they have issues with their insurance in terms of coverage?
So property insurance. Well, so I just actually met with a client who on 2 of the properties, the insurance company just pulled the insurance because come to find out the electrical had not been updated, and they had stated it was updated. So then she's running with no insurance. And as I mentioned before, because the requirements are getting that much more difficult, you're finding that fewer a fewer amount of carriers. So the world of property insurance is getting very interesting.
Yeah, and when I recommend it for our clients that are multifamily, do you have a good multifamily insurance broker you work with that is a real specialist in apartment buildings?
Yeah, so we refer individuals, and you had met them. They spoke at a couple of events years ago now, but Abernathy Insurance, the two brothers that were twins, and the reason why we refer our clients to them, maybe they're on this with us today, but they own a good amount of multifamily properties themselves. So of course they're having to always take a look at, okay, who are the current carriers and the coverage and what does it consist of and so forth. So Abernathy Insurance, they're located in Monrovia, California. You can ask for Brian Abernathy over there, and Brian or Mark Abernathy, and yeah, they'll take care of you. That's typically our first stop. But even for them, sometimes maybe they may not have a solution, and they'll refer you out to, say, an independent company. For one of my properties, they sent me over to State Farm, and State Farm's the company now who's no longer insuring multifamily properties.
So that's interesting, and I'm glad you brought that up, Chris, because I based on this day and age where you have so many changes with our vendors and supply chain, it's really critical to have these subject matter experts, not necessarily your auto insurance broker that doesn't understand apartment buildings. It's really important to make sure they have an umbrella policy to cover the assets as well as the homeowner's policy, and to make sure your insurance agent has dealt with claims specifically on those assets. So that way it's one thing to have a policy, but it's another to actually manage those claims. And that could be a very polarizing impact if the insurance company is difficult to work with to service a claim. So I always stress that, because insurance is always your first line of defense to protect yourself.
Sure.
So we talked about LLCs, we talked about trusts, and we've talked about insurance. The big question we get from landlords these days is, well, what kind of LLC or corp should I have? Especially with Prop 19, people are asking, should I have a C corp or an S corp or an LLC? And also another question is, now that what's the name of that municipal prop that just got passed on the excise property over 5 million, Chris? What's the name of that rule? And in Los Angeles,
they call it the mansion tax.
the mansion tax, does that apply for any type of real estate over 5 million or just single family?
For now, my understanding is a single family.
Okay, good. Because obviously they start like at a low level, like mansion, then eventually they'll go to commercial property or things of that nature. And for everybody on the call, I'm speculating. I'm not saying that's happened, but I was on a discussion forum with institutional folks, and they're contemplating using C corps if they plan on keeping their property for a long time, or trading it from party A to party B to get around that mansion tax, as an example. So it's an interesting dynamic, because prior to the mansion tax, nobody would ever mention the word C corp for real estate. And I want to reiterate for this call, for 99.9% of you, an LLC is the best vehicle for you to own real estate, not a C corp. And to your right, you'll see S corp. S corps are great for property management companies. So that way you can charge a management fee to your LLC to manage the property, and have that management fee income go to your S corp. The challenge you have with C corps is, if you have assets owned by a C corp, government does not treat C corps with capital gains treatment. They strictly treat you with ordinary income, and then any profits you have at a C corp are going to get taxed again to you individually. So it's a great vehicle for businesses, but not for real estate. So I'm going to pause there. If I'm going to look at the Q&A section, see if we have any additional questions here. So Robert has mentioned the ULA, also known as mansion tax in Los Angeles, says it's for all properties. It's 4.5% over 5 million and 5.5% over 10 million based on sales price, not profit. So there you go. So that, and then certain rare situations, folks are selling stock of the real estate versus the real estate itself and C corps to potentially solve that riddle about paying that mansion tax. And I don't recommend anybody to take this comment that I just made as tax advice. I want to be very clear about that. So you definitely want to talk to an expert specifically that understands that mansion tax to make sure that's worth your while to go down that C corp structure, which is very, very rare, by the way. The anonymous attendee, you stated that the trust should own the LLCs and each property should own and each LLC should own a property. Can you elaborate on the reasons that this arrangement is beneficial? So Stephen Spurrier will recommend that an LLC, you should have an LLC for each property. It's kind of like having a basket of eggs. If you drop that basket of all your eggs in it, all the eggs can break. But if you have 10 baskets and you drop one of the 10 baskets and one of the eggs breaks in just that one basket, you still have 9 other baskets with eggs that have never been broken. That's the analogy I can give you with why folks recommend, like Stephen recommend, an LLC for each property.
Because if they're just held in the family trust, then the entire everything in your family trust, including bank accounts, your primary residence, everything is at risk should there be a lawsuit on, say, just one property that's in that trust. And so that's why, again, each property, it's like wrapping a layer of protection around each property by having the individual LLCs, and then the trust owns the LLCs for the estate planning purposes, but the LLC is to protect you essentially on the liability aspect.
Thank you, Chris. And then Mark mentioned maybe a future webinar on multifamily property insurance. He has to upgrade electrical recently due to Federal Pacific panel. So that sounds very expensive.
Yeah.
And it's unfortunate, but safety first for our tenants. Another question: if our properties are in separate LLCs, we each having its own bank account and we keep business operations completely separate, do we have to have board meetings and meeting minutes to keep someone from trying to pierce the corporate veil? That's a great question for Stephen Spurrier. And limited liability companies are more flexible with corporate compliance or limited liability company compliance. And Stephen can go into the mechanics of that and creates, but LLCs typically have a lot more flexibility to protect yourself from piercing the corporate veil. And please provide the name and contact number for the property tax appeal. Let me pull that up right now before I forget. His name is Richard Ayub. I'm just going to do this right now online here. And his phone number is, can I put it in the chat box, Chris?
Yeah.
Actually, I'm just going to create let's see, where's the chat? The chat, here we go. I just put it in the chat box, and his phone number is 818-553-1300, 818-553-1300. Richard Ayub, and his last name is spelled A-Y-O-O-B. So that takes care of that. So we talked about entity selection, things of that nature. Chris, is there a common question you get about entities that I did not address on this slide?
No, but what I can tell you is because we're meeting with anywhere 3 to 5 multifamily owners a week, and as we're pulling the title sheets, many simply hold the properties in their trust, and so I hope in those cases they at least have an umbrella insurance policy that can cover, God forbid something happens, and to that point, and what Stephen Spurrier will tell people is, you think, oh, not me, not now, that wouldn't happen. And then he's had crazy things like a staircase fall at an apartment building and just some wild things. And of course, the insurance carriers, the first thing they do is try to find a way to deny coverage. And they're not first looking to see how to look out for your best interest. They're first looking to see how can they deny coverage. And so, I think you'd be surprised, Steve, how many people are kind of flying exposed simply by holding it still in their personal name, not using an entity to protect their overall finances.
Right. Right. Good point. So, next topic, ironically, one of the folks just asked this question: can an S corp pass through schedule E income without being assessed self-employment tax? That's a very timely question, and this slide is going to talk about this. So let's say you have 100,000 in income and profit. What you can do is pay yourself a salary of $40,000 and have 60,000 left in profit. Well, what happens is you're taxed on your profit without paying Social Security tax. So let's do an example here. On that $60,000, the government will not tax you on that self-employment tax. So you'll save about almost $10,000 on this profit by being an S corp, and then this $40,000 will be subject to the Social Security tax. So an S corporation is a great vehicle for business owners to save money. And can you save money by incorporating in a different state? The answer is no, you can't. You have to have a corporation or an LLC in the state that you do business in. You just can't have a business operation for real estate in another state that you operate in California. So you definitely need to be compliant with the franchise tax board. Can you have a home office post-COVID, Chris? I mean, what percentage of your clients now have gotten rid of their offices and work from home?
I mean, many, right? Especially because the technology has went in the direction of it. Why not? It's so easy anymore.
It really is. I mean, it's here we are on Zoom. I'm 3,000 miles away, and we're talking to 30 folks, 40 folks.
I mean, I got my wife cooking in the back here. No, I'm playing. I'm at the office, but no, right. I mean, many people are working from home.
Yeah, it's great. So what we always ask is, if this home connected to your business? If it is, and if you're not an employee and you use it exclusively and regularly, and this is your business location, then you could deduct the property as a deduction for a home office. But if you have an office somewhere, like you do, Chris, you have an office, and then you have your home, you can't deduct both. You can only deduct one or the other. But let's say you got rid of your office and you worked from home, then you'll be able to deduct your home office as an example. For some folks out there that still have an office, that's important to differentiate.
So in other words, if they're running a real estate rental business and they section off a portion of the house to do their management activities, now a certain square footage of the home can be written off for utilities and things like of this nature, correct?
Correct. You got it. Cost segregation. So one topic we've talked about, Chris, is cost segregation. And this is really important for folks to know, especially we're going through a very choppy market where some years you're going to be in the highest tax bracket, and then some years you're going to be in a lower tax bracket. And cost segregations are a great way to offset your income if you're in a high tax bracket year. So let's talk about how that works. If you don't have a cost segregation, you'll see this person owes $4,000 in taxes. So simply by having a cost segregation where their income is 155 without the cost segregation, and then here between federal and state, they owe, let's call it $8,000. Now with the cost segregation, their income is now 115 grand. They're going to save $9,000 in federal tax just by deducting a $39,000 cost seg deduction, which is 23% tax savings. So you could swing the other direction with a cost segregation. And folks may ask, what is a cost segregation? What does that mean? What it is when you have real estate, the government requires you to deduct your real estate over 27 and a half years. And with the cost segregation, I could accelerate the time of 27 and a half years into 1, 2, 3 year periods, 7-year periods. So you can get 27 years worth of deductions all in a couple of years to offset against your high tax bracket year of earnings. Now, This will only work if you're a real estate professional, where you spend over, let's say, 1,000 hours in real estate and over 50% of your time in real estate to qualify for this deduction.
Now, I will mention that we did have Dave Barrett did speak at the live event from Cost Segregation Services, who you introduced me to, Steve. And I also conducted a YouTube interview with Dave Barrett. So Matt, if you could please share the link to that video with the attendees, I think that'd be helpful too for those that still have not seen that video, because Dave Barrett really dives into the ins and outs of the cost segregation, which I ended up having at your suggestion. I had a cost segregation study done last year on one of my properties to mitigate, because like you said, it was one of those years where we said, hey, it makes sense given the income earned to accelerate that depreciation, against my tax liability.
And what's great, Chris, is we were able to cherry pick which year to do it too, right?
Right.
Where we say, hey, this is the year to pull the trigger. And then in some years we'll say it doesn't make sense to pull the trigger. So this strategy is a great strategy that you can use on a year where you have an unusually high amount of income to offset a deduction with. And also keep in mind, Congress keeps on changing the rules. As we all know, our current Congress will create laws that are good for 2 to 4 years, and then they'll change them. So it's important to know that too, because just because the cost seg is available today doesn't mean it's going to be available in 3 to 4 years. Or the 27.5%, 27-year depreciation rules could change too. And for example, in 1986, Ronald Reagan changed all the rules in depreciation in 86, and we could always have another tax reform in the fall, depending upon what the House and Senate decide to do. And this is not a political discussion. This is just a historical overview of what we've seen over the years, where the pendulum swings one direction to another as far as tax rates and what you can deduct or not deduct during that specific calendar year.
Is there any particular reason, Steve, that someone would say having a cost segregation study is not a smart thing to do?
Yes, if you're in a low tax bracket, and if you're in a low tax bracket, it doesn't really make sense to do, because if you don't want to accelerate write-offs in a year when you're in a 10% bracket, because you want to achieve a rate of return on the investment and the cost seg to save money on taxes.
And we had a question come in on cost segregation. So I would, to answer that, I'll point you to our video. The link was shared. That has all the answers you could have in terms of what is cost seg, how does it work, and so forth. So we'll point you to that for that question. But thank you for the question. So 1031 exchanges. So at the opener of this, I had mentioned that the rent control issue, and people are looking to sell in one area, move to another that's maybe more friendly, has no local statewide rent control. And so I would imagine everyone here understands how a 1031 exchange functions. So let's talk about capital gains, Steve, for a minute. If we sell and just cash out, because this is a question I received prior to the event leading up to our webinar here today. Somebody wanted us to discuss this. Capital gains taxes. Someone says, you know what? I don't want to do a 1031 exchange. I'm beyond management. I don't want to be in the business because of the politics or whatever the case may be. What am I going to pay in taxes? So how does that break down?
Great question. So if it's over $1 million, the state tax rate is 13.3%, and the federal tax rate is 23.8% if you include the Obamacare tax of 3.8%. So it's 20% capital gain, 3.8% Medicare, Obamacare tax, and 13.3% for California. If the gain's under $1 million, the federal rates are the same, but California rates are 9.3%. And keep in mind, it's that the tax rate for California is not based on just the asset; it's based on all your income. So if you make money from other sources, you made $100,000, and you have a $950,000 gain on your real estate, they're going to be over the $1 million, and all your income will be taxed at the highest rate. A portion of it will be taxed at 13.3% for California. So I want to pause there for a second, because Ron had a question. If I sell real estate in California, held in a California LLC via a 1031, to purchase real estate out of state and I live out of state, do I still have any tax liability to California? The answer is yes, because California tracks the basis you had in that property. So when you buy another property in a 1031 exchange, you're to defer your gain to the state of California. But when you sell that property in the future, regardless of where it's located, you're still going to have to pay the state of California tax on the gain that you deferred from an earlier 1031 exchange.
And
So
then how would that work then if you purchase something out of state? That obviously goes up in value over time. There's capital gains to be paid there. So are you then paying the capital gain? And when you go to sell and exit finally from that, say that second property, are you paying the capital gains to that state of that property? And then on the original property, the down leg, as we would call it, you're paying the capital gains owed just on that property of the California, or how would that break down if between the two purchase and sale?
if you sell a property in, let's say, Nevada or Texas, you're just going to pay California the gain. But if you're in a state, let's say like Oregon, where you buy a rental and then you're going to pay the state of Oregon again, whatever you pay in Oregon and California, there will be a credit on whatever you've already paid tax on between the two states. But you're still going to have to pay California the tax regardless. Because the gain would have been taxed at the time before you did a 1031. And regardless if you moved out of state, they want their money. Now that's California got wise on this because prior to, I want to say 10 years ago, California did not track your gains that went out of state. Now they track it through a specific form you have to file on an annualized basis to prevent getting taxed in that year. Because if you fail to file that form, you get taxed. So on one of these one point here for landlords, you have what's called a qualified business income flow chart. And if your income's under $400,000 and you are, $329,000 and you're married, you get a 20% deduction on your profits from real estate and you don't pay taxes on that portion of it. But if it's over $429,000, a portion of it may be limited. So this is a great program where we make decisions on whether or not you should fund retirement plans so that you can get your income below these thresholds to get an additional 20% bonus and tax savings on your income. So we have a question before we go into this. We have a question from an anonymous attendee. Someone I know did a 1031 exchange by selling an agriculture ranch in California for an apartment building in Texas. Is that considered a like-kind exchange? The answer is yes, because the land is considered like-kind. The government doesn't care what kind of building you have on the land. It could be a ranch to a building, apartment building. It could be a house to an apartment building. It could be an apartment building to an industrial building. So the definition of like-kind is the dirt itself. And to conclude this presentation, if you have any questions about what we talked about today, and you would love to talk to one of our associates, you could text this word, Robert Hall, to this number 72000, and we'll do a free analysis on your tax situation to see what we can help you with from a tax planning perspective.
Now, I have a couple of questions for you here, Steve, from personal clients. They submitted, they knew we were leading up to this, and they said, hey, can we pose these? So in our final minutes here, that I'll rapid fire some of these. When it comes to repairs, determining whether something's a capital improvement that should be depreciated versus putting it in the line for general maintenance, how does one decide between the two?
Great question. It depends on what your taxable income is, one, and two, it's going to depend on what your bankability is. For example, sometimes when you depreciate the asset, bankers will exclude the depreciation deduction from your cash flow statement for refinancing purposes. So, but from a tax perspective, typically if it's something that could be maintained, and for example, if you're patching tiles in a bathroom, you could deduct that as an expense. But if you're doing a full-blown kitchen remodel or bathroom remodel, you need to depreciate it.
Got it. Seller financing. So someone sells their investment property. When they sell it, they carry back financing for the buyer. How do the taxes work out? They're receiving an initial down payment. Eventually, they'll receive a balloon payment at the end of the term of the loan. Along the way, they're going to be receiving the mortgage payments. How do the taxes work on that scenario?
Great question. So the mortgage payments have two components. You have principal payments and then you have interest payments. Interest payments are fully taxable at ordinary income. The principal payments you receive is going to be what's called an installment sale, where you're agreeing to get paid over a period of years. As a result, if your capital gain is, let's say, a third of the profit of the building you bought it for $500,000, you sold it for $750,000, and a third of it's taxed capital gains, then 1/3 of your principal payments you receive every month will be subject to capital gain, plus the ordinary income of interest that you receive on a monthly basis, which will be taxed at ordinary income.
Got it. Defined benefit plan. Now you mentioned, making a decision on retirement vehicles. Of course, you've set up retirement vehicles for my wife and I that we actually purchase real estate in. But how does one know with regards to a defined benefit plan, if they're a candidate, if it's something that would be advisable for them?
It really depends on their personal situation and what their bracket is and what their short-term and long-term goals are. For example, if you're older and you want to defer the income to lower your tax rate, it's a great vehicle. But if you're younger and you need the money to put down payments on real estate, it may make sense not to do a defined benefit plan. It just depends on the bracket you're in and where you are in life with your retirement plan or your cash flow plan.
So it takes that one definitely takes a consultation to get it definitely more personalized. Yeah.
Yeah, it's not one size fits all rule.
Number one mistake landlords make when it comes to their taxes.
The number one landlords make when it comes to their taxes is really simple: not planning ahead. I see folks after the fact that after they did a transaction rather than prior to a transaction, or failure to plan during the year to minimize their tax liability, such as a cost segregation study, things of that nature.
And in the past, you've always given us some sense of your financial outlook. You mentioned it'd be interesting if we went through the highlights of our past events, the predictions that different folks have made and how that's played out. The way you see things now, inflation, the way things are going with interest rates, how do you see things, shaking out, say, over the next year in the financial markets when it comes to real estate?
I think we're going to see a correction because interest rates are up. And there's a period of denial we have right now where folks that want to sell it for a high dollar amount. And the folks that want to buy can't afford that high dollar amount because the mortgage payments are too high because of the interest rate. So we're going through that freezing period. I call it the winter period, where we need to wait for the spring to thaw the ice a little bit. And then when the ice starts thawing, you're going to start seeing properties come down just because interest rates are much higher than they were 18 months ago.
Mm-hmm.
That these payments are much more expensive for the buyer to service the debt. And once we get through that thawing period and we get into the summer period, I think we'll see more inventory, but naturally that inventory is going to be priced at a lower rate. But what happens from the summer period of all that inventory and whether prices go back up or down, it comes down to what our federal government decides to do with our financial system with interest rates. Because every time you and I, Chris, we try to get a crystal ball out to forecast what happens, the government
Right.
either prints more money or they lower interest rates, things of that nature. So there's so much data that we're not privy to. It's hard to forecast beyond the thawing period of the psychology of sellers wanting to sell.
No, and you hit the nail right on the head that we're at a period where sellers, maybe they had an evaluation done of their property, say this time last year. Now they're saying, okay, I'm ready to go. And the broker's saying, well, it's somewhat of a different world because interest rates have gone up significantly since then. I got a call from a gentleman yesterday, has an apartment building. I met him maybe August, September of last year. called me yesterday saying, okay, now I'm ready to sell. Well, interest rates have gone up. You know, we need to retake a look at the numbers. And he thought, wow, in that short amount of time. And I'm thinking, yeah, I'm not saying it's changed tremendously. I'm just making you aware of it was an easier sale last summer than it is this summer because buyers are saying, look, I need a higher cap rate. Bottom line, I'm not going to lose money on money borrowed. The interest rate on a commercial loan today says 5.75. I'm not going to lose money on that. We need to see 4 caps are gone. 4.5 cap is gone. Now we're headed towards 5 and assumably above 5. And that's what we see playing out in the apartment world.
Yeah, you're seeing the thawing period, right?
Mm-hmm.
So, and I think we're going to see a lot more in that, and it could accelerate. The thawing period could accelerate if we see more money being printed, and we see a higher interest rate. I'm lost for words because I have no idea what's going to happen beyond the thawing period. And every time you and I, Chris, try to forecast it, a COVID environment occurs or some kind of a third party event that that's unique to that specific time period happens. So that's why I love real estate. As long as you have multiple tenants in a building, you can pretty much mitigate that risk of the wild swings of what happens in the financial markets.
Sure. Well, Steve, I want to thank, I know you have to run to your next appointment, but I want to thank you for your time here this morning. Why don't you share the phone number of your office if people want to reach out via phone, get some more advice? How do they reach Robert Hall and Associates?
Thank you, Chris. The phone number is 818-242-4888. That's our phone number, 818-242-4888.
Excellent. Yeah, that's in the chat as well. Steve, again, thank you for your time, and we will talk soon.
Thank you, Chris. Have a great day.
And I hope those of you that attended our webinar, you found today's webinar informative. We plan to have more of these in the upcoming future. You heard me mention our live event several times. If you have not attended one of our live educational luncheons, you must get yourself there. This is where we have all the professionals in the room from the legal, financial, and otherwise. And so then your questions are answered in a multifaceted format because oftentimes questions have a legal aspect to it, a financial aspect, and what have you. Our next event will be in the fall. If you own multifamily properties in the areas that we service, that's how you know you're invited. You receive not only email invites from us, but you also receive mail invites as well. Head over to our YouTube channel. There is hours and hours of free educational content that you can find there. Search around. Any question you have, I imagine the answers are already there. And as I mentioned, we're going to continue sharing this educational content. I hope that you're finding it informative. My goal is to assist you in the building of your financial legacy that you're building in multifamily properties. And until we see each other again, I wish you positive cash flow, tenants who behave, and much protection from Uncle Sam, Chris German, the apartment dealer, and we will talk soon.